All right, here we are again, okay? We're going to wrap up Chapter 5 today. We might be able to start Chapter 6, but we're going to certainly wrap up Chapter 5, okay? So I think I assigned you about 6 things to do today, did I not? So let's go through those. Hopefully you got those done. Let's go ahead and jump in and do, let's see. We're going to do them kind of out of order, okay? So the first thing I want to do is exercise 5-4. Let's do exercise 5-4. All right? Now these are transactions in regards to the sales cycle, correct? Okay. So let's go ahead and take a look at this. Exercise 5-4, bottom of page 207. Mechanic Parts was organized on May 1st of 2009 and made its first purchase of merchandise on May 3rd. The purchase was for 1,200 units at a price of $7 per unit. On May the 5th, Mechanic Parts sold 720 of the units for $11 per unit to Radica Company. Terms of the sale were $210 net $60. Prepare entries for Mechanic Parts to record, and it's kind of this problem's a little bit strange the way they word it. You got to really kind of pay attention here. They want us to record journal entries for Mechanic Parts to record the May 5th sale and each of the following separate transactions A through C. Okay? I'm not sure why they didn't just make that May 5th sale part of the list down there, but they didn't. Okay? And using a perpetual inventory system, of course. So are we doing sales cycle here, or are we doing purchase cycle here? We are doing the sales cycle. So shift your brain into that gear, okay? So we're going to be dealing with those accounts like receivables, cost of goods sold, sales, those sort of things. All right? Okay, let's take a look first at the May 5th sale. All right? All right, let's take a look at that. Blow that up a little bit. Let me back it off. Okay, now we have 2 entries, don't we? We have 2 entries. Whenever we make a sale and we're using the perpetual inventory system, we have to make 2 entries. Don't combine those into 1 entry, okay? Go ahead and make those as 2 separate entries. But up here, we debit receivable and sales for the sales price times 720. And down here, we increase cost of goods sold, and we decrease our merchandise inventory for the cost of the items. Is that correct? Did you guys get that? Okay. Again, make sure you know which account goes where. On the test, students always mix up these accounts, and they can never remember which are the big numbers and which are the small numbers. So make sure you have that. Okay, that was the May 5th entry. On letter A, on May 7th, Radica returns 251 units because they did not fit the customer's needs. Mechanic Parts restores the units to its inventory. Now, once again, we're Mechanic Parts. We're the seller, right? So what we have to do here, it's almost a flip-flop of the above entry. But we don't debit sales, but rather sales, returns, and allowances. And what type of account is sales, returns, and allowances? Remind me? It's a contra revenue, but it is a debit balance. So we sold those for 11. So those 251 that we returned, or that our customer returned rather, we decreased our receivable, we increased that contra revenue, we put the items back into inventory, thus we debit it, and we credit or lessen cost of goods sold, because in the end we didn't sell those goods, did we? Questions on that one? All right. Letter B, on May 8th, Radica discovers that 60 units are damaged but are still of some use and therefore keeps the units. Mechanic Parts, that's us, we send Radica a credit memo for $180 to compensate for the damage. Okay. Now here we don't return any items to inventory. Let me go ahead and draw a line between those dates so you can keep them separate. Here we don't return any items to inventory. They keep the goods. We just say, hey, we'll knock off $180 from what you owe us. Okay? So we decrease receivable, and we debit sales, returns, and allowances. Does that make sense? Make sense? Okay. Okay, lastly, on May 15th, Radica discovers that 72 units are the wrong color. Radica sounds like a high-maintenance customer, does it not? Yeah. Okay. On May 15th, Radica discovers that 72 units are the wrong color. They keep 40 of these units because Mechanic sends a 92 credit memo to compensate. However, Radica returns the remaining 29 units to Mechanic. Mechanic restores the 29 returned units to its inventory. Okay, you know, I tell you what I like to do. I actually like to do this in two separate entries. Okay, now I'm going to be working off the cusp here.
Is when it says Mechanic restores the 29 return units to its inventory, is that when you have to like put that second entry?
Yes,
okay.
That's correct. That's exactly correct. Okay. So first of all, let's go ahead and record the $92 credit memo. Okay, the $92 credit memo. So what we would do there is, yeah, we would debit sales, returns, and allowances, and credit AR for how much? 92. Yeah, and I'll show you that in a second if you did it all in one entry. Okay? So that is in regards to the items that we just sent a credit memo in regards to. Okay? Now let's do the other part. The remaining 29 units they sent back, correct? Okay? So, let's go ahead and make that entry. Let me move this up a little bit. Okay. Hold on a second. All right. So for that, we would debit sales, returns, and allowances, and credit AR, and we would also debit merchandise inventory and credit cost of goods sold, correct? All right, so what is 11 times 29? So, what is it? 319, thank you. And the items that we return, 29 units times the cost of 7, what does that equal? 203. Okay, so, and I'll show you what the combined entry here is in a second. Here in the red is the items that they kept and we just sent them a credit memo. Here are the items that they actually returned to us and we put them back in inventory. And so you're right, Gil. Those ones in the green, those require the second journal entry. Okay? Now, if you combine these into one entry, it would simply be right here. Once again, let me draw a line between those dates. It's this info right here. Okay? Okay, questions on that? Yeah, hold on one second.
Will there be a certain way you want us to do it on a test? Or would
Nope.
it matter?
Either way, it's the same. It's the same either way. The net effect is the same, I should say. So you can do it. You can either do it combined, or you can do them separately. I don't know. It's easier for me to think through them separately. All right. Okay. Any questions on exercise 5-4? Okay. Well, good. What I want to do now then is exercise 5-2. Now this was a great one to practice, especially when you're studying for the test. And what I sometimes recommend is that I didn't bring any scratch paper today to write on, so I'll have to make do. what I sometimes recommend for a student when they do this one is to do these journal entries side by side. That's all right. I'll be okay. Thanks, though. Okay? I almost recommend that you do these journal entries, record the transaction, what it would look like on the buyer's books, and then over here on the seller's books. And you can see them side by side. Okay? Now, we can't really do that because of the limitations of this little Elmo. In a regular classroom, I kind of do this on a big whiteboard, big wide whiteboard. Okay? But when you practice this, you might get a piece of paper out and try to do them side by side, and you can see then how they kind of contrast with each other. Okay? But let's go ahead and take a look at the answer. Exercise 5-2. Fortuna Company purchased merchandise for resale from Lemur Company with an invoice price of $30,000 and credit terms of $210 net $60. The merchandise had cost Lemur $20,100. Fortuna paid within the discount period. Assume both the buyer and seller used the perpetual inventory. Okay, who's the buyer here? Fortuna. And who's the seller thus? Lemur, or whatever that is. Okay. Okay, prepare entries that the buyer should record for the purchase and the cash payment. And then prepare the entries that the seller should record for the sale and the cash collection. Okay, let's do that. All right, let's just take a look at them all at once. Here is for the buyer. Fortuna Company. Here's when they purchase the merchandise. And here is when they pay for the merchandise. Okay? Now make sure again that you're shifted into the purchase cycle when you do Fortuna Company. Okay? You don't want to see accounts like sales or accounts receivable or cost of goods sold or anything like that. That's the sales cycle. We're not doing the sales cycle right now. We're doing the purchase cycle. Okay?
When you're doing this, your credit accounts, doesn't matter what order they're in?
No. If you put cash first and then merchandise inventory, that's fine, as long as they're both credited. Okay? All right, let's take a look at the seller's journal entries. Okay? Let's take a look at the seller's journal entries for Lemur Company. All right, now we have, let me go ahead and draw a line there to separate those. This is for the date that they sell it. Okay? There's two entries. There's two entries. And then below is the cash collection when Fortuna pays Lemur Company or Lamar or whatever that is. Okay?
Where'd you get the cost of goods sold and the merchandise inventory, that entry?
Actually, I think they give that in a separate sentence up there. I think I remember reading it. The merchandise had cost Lamar $20,100. See it right there in the middle? Okay. Now, this is a great one to practice for when we get closer to the test. If you can't do this problem, you're not going to do well on the test, okay? Now, again, on the test, I always get such crazy, wacky answers. Looking back at the Elmo, I just get all sorts of accounts mixed up in here, okay? This is a perfect example, once again, of something that when you watch me do it, you might think, this is obvious, this is easy, I got it. But when presented with a blank piece of paper and a problem to solve, you're getting the wrong accounts or the wrong amounts or all that, okay? So make sure that you practice with a blank sheet of paper to see if you can do your homework. Does that make sense? Okay? All right, you know what? I don't even want to worry about part 3 on this. I forgot to tell you that.
Yeah, thanks.
Thank you, Dave.
But how would you do that?
You know what? I don't even want to go through the answer. If you want, we have talked about this,
Yeah, we did.
and suffice it to say, what they're trying to say is, It is doggone expensive when you don't take those discounts.
Could I just said that?
Okay? Yeah, if you said that, you could. But I think what they do, I will put the answer up here, but I'm not going to talk through it. Okay? If you want me to talk through it, schedule a time, come in office hours. We'll both grab a Diet Pepsi, and we will talk through this. But this is more confusing. The only thing they're trying to get us to believe, and it is true, is that when you do not take these discounts, it is truly very expensive. But I think a much better way to do that is the way we did it before, is figure out the annual interest cost as opposed to this savings per day or whatever. This is just, it's nutty. Okay? So there will be nothing like this on the test. All right? So don't worry about that. I think it's overly complicated. So I should have told you that as you spent last night crying while you tried to do your homework. It's all right. It builds character. Okay. Any other questions on that one? All right. Let's keep on going. Let's jump over to Quick Study 5.3. Now, Quick Study 5.3, they want us to compute net sales, gross profits, and the gross margin ratio for each separate case A through D. And they want us to interpret the gross margin ratio. And I believe that was one of the ratios that I wanted you to learn. Is that correct? Or I wanted you to read about. Okay? So first of all, let's do our computations. Okay? Now, I highlighted in yellow the information that they gave you. Okay? They gave us sales, sales discount, sales returns allowances, and cost of goods sold for each case A, B, C, and D. Okay? And what you needed to compute was net sales and then gross profit. And then what they wanted you to do was compute the gross margin ratio. Now, what is the gross margin ratio? The gross margin ratio is the gross profit divided by net sales. Okay? Now, which one of these has the highest gross profit or gross margin ratio? B, right?
Decimal points.
Okay, that's a great question.
Because I didn't know what you were.
That's a great question. My rule of thumb is to always take it to one decimal place. Okay? Because think about it. If you just rounded to the nearest decimal place, then a 36.4 or a 35.5 would both round to 36%, right? And in the real world, there's quite a bit of difference between that, okay? So I would always take it to one decimal place, whatever you're computing. Make sense? Good question. And I understand if you didn't do that. The gross margin ratio basically shows how much you mark up your product. How much you mark up your product. If you mark up your product quite a bit, then your gross margin ratio will be higher, won't it? Can you think of an example of a product that is marked up quite a bit?
Coach Purse.
Okay, Coach purses, I know nothing about those, so I'll trust you on that. Spencer? Fireworks. I've heard that. I have heard that. Here's the example that I always use. Beer, an example near and dear to some of your hearts. Okay? Beer, go to a Chiefs game. What are they selling beer at a Chiefs game for these days? $8?
Yeah.
How much do you think that beer cost them? Oh, it's just cheap. Beer is cheap. It's just cheap. Okay? When you get it in bulk, beer is cheap. And then they majorly mark it up and sell it to you at a Chiefs game, right? They make a lot of money on that beer at the Chiefs game. I used to work on the audit of the stadium out there, and I saw how much money they make on parking and beer and stuff. It's a lot of money. Okay? Beer has a high gross margin ratio. Can you think of another of a product that has a more of a low markup, and that's a low gross margin ratio? The example I always give is milk, since we're on drinks. Okay? Milk has a, from what I've heard, anybody work at a grocery store?
Yeah, I used to.
I've heard milk has a relatively low markup. And the reason is, I mean, what does a gallon of milk sell for? $3.50?
It's more of a necessity.
Huh? Yeah, $3.50, $3.30, somewhere around there. So let's say that the milk costs $3. Well, that would be a low markup. Why would milk have a low markup?
Because it's more of a necessity, just like bread is.
It's a necessity, and a lot of times when people go to the grocery store, it's because they need to go get milk, right? And so they want you to be the place. They want themselves to be the place that you think of when you need milk. Okay? And where do they put the milk? Right up close so you can just run in and get it? They put it in the back. The farthest point of the store is where they put their milk. Is that correct? So it's kind of like they're thinking is this. We're not going to make a lot of money on our milk. So let's not mark it up high. Our gross margin percentage will be low. But when they come get milk and then they pass the chips aisle, they're going to go, oh, some chips and salsa would be good tonight while I watch the game. And then you go, oh, look, Nutty Bars are on sale, right? Hey, 2-for-1 Cocoa Puffs, right? Boy, these Skittles look good, right? All this sort of stuff. Oh, frozen pizzas. I need some of those for the boys, okay? And before long, how many times you gone to the grocery store just to get milk? And then you're standing there in a carton going, how does this happen to me, right? Happens all the time, right? That makes them smile. That's why they put the milk in the back, okay? That's why they put the milk in the back, okay? All right, so that is gross margin ratio. I always sometimes call it the gross profit ratio as well. Any questions on Quick Study 5.3? Let's talk about Quick Study 5.4. Accounting for inventory shrinkage. Cristo Company's ledger on July 31, its fiscal year end, includes the following selected accounts that have normal balances. Okay. Now, they did a physical count of its July 31 year-end inventory, and that count revealed that they have 40,600. Okay, so here's the situation. Your books tell you that you have $42,000 worth of merchandise inventory, right? When you do a physical count, it's saying that you have 40,600. Okay? Who's right?
You?
Well, the count is right. Correct? As long as you didn't forget to count something or something like that, the count is correct. So you need to adjust to the count. Now, why might the count be lower than what the books say?
Employee theft.
Yeah, it's probably theft. Okay? Anybody here worked retail? Raise your hand if you worked retail. Where'd you work, Keeper? Kohl's. Where'd you work, Anna? Okay. You worked retail, Brian?
Yep.
Where?
Small town grocery store.
Small town grocery store, Gil?
Johnson's, like men's warehouse type thing.
Okay. I'm going to guess that Kohl's has some inventory shrinkage, do they not? Now, from what I have heard, and we'll talk about this more in chapter 8.
I worked in the beauty counter with the makeup, and they started having to lock everything up because everything was just being taken, just
Are
locked
they more
right
concerned with employee theft or customer theft?
Well, at the time it was customer theft because
Really? Because most students I've talked to, I talked to students who worked at like some electronics, like Best Buy or Circuit City or whatever, and they said they have much more trouble with employee theft than they do customer. Is Target like that?
Yeah, I worked at Target. There's a guy in the electronics out would always take iPods and stuff.
Yeah. Yeah. Was this you?
All
Because
the
you're on TV
time.
right now. Okay? Cops are watching. If you work in a store like Best Buy that has things like iPods and DVDs and CDs, you better, by golly, you better have a great system of internal control, or you're going to have a lot of inventory shrinkage. Okay? Because those are the sort of items that people like to steal, right? And if you go to Best Buy, look up in the sky sometime. What are you going to see up there?
Cameras.
The eye in the sky, kind of like a casino, right? Because those are the sort of products that people will steal. Now, I've always wondered, if you go to a store, a retail store, like for instance, you ever been to a fabric store? My mother, when I was young, she used to drag me to the fabric store, because that was back in the days when she made clothes for us. And that's a whole nother emotional nightmare that I will tell you about someday. But we used to go to the fabric store. Well, thinking back to the fabric store, they have, all these reams of material. I always wondered, do they have a lot of theft there? Because who goes to fabric stores? Little old ladies. It's hard for me to think of one of them, stealing a big thing of burlap or something. Okay, but maybe they do. I don't know. Okay, these times are tough, right? But if you work in a store, Target would be another one. Okay, Target, there's a lot of stuff people would like to steal. Okay, and so you have to look at things like inventory shrinkage. Well, what do you do then when your books say that you have 42,000 worth of inventory, but when you do a count, it says you only have 40,600? What you have to do is you have to write it down. Well, what we're going to do here is, first of all, we're going to credit merchandise inventory for 1,400. Okay? We're going to reduce merchandise inventory down to what it actually says, what the account actually says it is. Now, it may seem weird that we debit cost of goods sold, because some students say, well, we didn't sell this. Well, I think the rationale here is that we consider that kind of a cost of doing business. I can tell you, if this was a really, really large number, I could see some companies maybe not debiting cost of goods sold, but maybe debiting like a loss from theft or something like that, and having it be a separate line item. Okay, I'm imagining the Targets and Kohl's and Best Buys of the world, they know how much they have to adjust for inventory shrinkage. Okay? Okay? Questions on that? Not too much, not too hard. Okie doke. Quick Study 5.5, okay? What they want us to do is refer to Quick Study 5.4 and prepare journal entries to close the balances in temporary revenue and expense accounts. Remember to consider the inventory for shrinkage that's made to solve Quick Study 5.4. Okay, what they want us to do here is to make closing entries for that situation. The closing entries are, and I think they just do the first two, okay? But obviously the ones they want to highlight here are these three accounts. Okay? Those are the three new accounts that we have learned this chapter. And what this quick study is for is to point out the fact that these three accounts are in fact temporary accounts, and thus they are closed in the closing process. Make sense? Now, we close those with the expenses because all three of those accounts that are highlighted in yellow, all of them are temporary accounts that have normal debit balances, just like the expense accounts. Okay? So we close them when we close the expenses. Does that make sense? Now, you might have your cost of goods sold. Did you get a different number? You might have, because perhaps you forgot to post the Quick Study 5.4 inventory shrinkage amount to the beginning balance of cost of goods sold. So that's where they came up with this $116,400. That's the original balance of $115,000 plus the $1,400 amount that we did up here in Quick Study 5.4. Make sense? Yeah. Okay. Good. Any questions on that? Okay, let me think here. Okay, I think we're doing okay. I think we can get through everything we want to get through, at least that I want to get through today. So let's do quick study. What's the last one I signed? I only signed one more, was it? 512? And that's the only one we haven't done, right? Okay. Let's do exercise 512 real quick. Exercise 512. Compute the current ratio and the acid test ratio for each of the following separate cases. Which company case is in the best position to meet short-term obligations? Okay, you might remember the current ratio, right? The current ratio is current assets divided by current liabilities. And that measures a company's ability to pay its short-term liabilities, correct? The only thing with the current ratio is, for all practical purposes, it counts $30,000 worth of cash the same as it would $30,000 worth of inventory, right? Now, which is easier to pay bills with? $30,000 worth of cash or $30,000 worth of inventory? Okay, so the acid test ratio says no, 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 no. We're not going to count every every current asset as equally the same. We want to just look at those current assets that are very, very liquid. They are easily and quickly converted to cash. So they only count in the numerator, not all the current assets. They count cash and cash equivalents, short-term investments, and accounts receivable. Okay? They do not count inventory. They do not count prepaid assets or anything like that. They only count cash and cash equivalents, short-term investments, and accounts receivable.
In this case, it'd be current receivables.
Yes, current receivables. So, in the example that we're looking at, we will not count inventory or prepaid expenses in the acid test ratio. Okay? Now, they want us to compute both of them, don't they? So let's do that real quick. Okay, let's take a look at that. Let me just let you check your answers here for a second. This is the current ratio where it's current assets divided by current liabilities. So we count all of the current assets in that numerator, and we get these current ratios. Here we use the acid test ratio, so we only count these items right here in the numerator. We call those sometimes the quick assets, maybe because they can quickly be converted into cash. Thus, our current liabilities are still these amounts. And then our acid test ratio is on this row right here. Okay? Okay. Now, which of those companies appears to be in the best shape?
Why?
Is it Y? Yeah. They have the highest current ratio, and their acid test ratio is highest too, isn't it? Okay.
Yeah.
So they seem to be in pretty good shape. Okay? Do you see why the acid test ratio is a little bit more of a conservative measuring of your short-term liquidity? Because it recognizes that not all current assets are equally liquid. Okay? Cool? All right. I think we're done with chapter 5, aren't we? Now, a teacher who didn't love you as much as I do would let you go at this point. Okay? But a teacher who really loves you, like me, says, we're going to go ahead and start chapter 6. Because there's a few slides I want to get through. Okay? So, I want you to look at your chapter 6 PowerPoints. Now, for you folks here, I printed yours out a little larger, didn't I, than I usually do? I usually just put 3 to a page. Didn't I put 2 to a page this time?
Yeah, but there's no lines.
That's all right. You can weather that storm, Brian. I printed it out a little larger because chapter 6 has a little bit more detail. Now, the biggest challenge we have on chapter 6 in this format is that this is the chapter I wish I had a big whiteboard across the room that I could work on. And I don't, do I? I basically have the screen, just this television screen, both for you and for you folks at home. Okay? So that's all right. We'll deal with it. We'll work through it, and there's some ways around some of those challenges. But that will be the challenge that goes through this whole chapter. Okay? We're just going to start this chapter. We're going to talk about chapter 6, inventories and cost of sales. Okay? Now, looking at, let's take a look here. If we take a look at the entries when we make a sale, what we do is we debit accounts receivable and we credit sales, right? And then we debit cost of goods sold and we credit merchandise inventory, correct? And we've always just told you what the cost of goods sold is, right? And that's what you're going to reduce your inventory by when you make a sale. This chapter, however, we're going to really dig into how do you get the numbers that go in this second entry. Okay? How do you get the entries or the numbers that would go into this second journal entry? Okay? So there's a number of questions we have to tackle. One of them is, what items do we even include in our inventory? Okay? Well, we're going to include all goods that a company owns and holds for sale, regardless of where the goods are located, and we have to also take into account. Okay, wait, what was that saying? We need to take into account all inventory, regardless of where they are located when the inventory is counted. What does that mean? That means we're going to have to pay special attention to 3 categories: goods in transit, goods on consignment, or damaged or obsolete goods. Let's handle those in turn. Now, we've already talked about what about goods that are in transit. What if you literally do your inventory count at the end of the year, December 31, 2009, or whatever, and you know that across the country there are trucks bringing inventory items to your retail store? Do you count those in inventory or do you not count those in inventory? Well, it depends. The question is, who's paying for that transportation? Whoever is paying for the transportation while items are being transported, they're the ones that include them on the inventory. They're the ones that own it. Does that make sense? So if there are certain trucks that you, as the retailer, are paying transportation, you include those in your inventory. However, if there are trucks full of items that you're not paying transportation, then you do not include it in your inventory. Make sense? So just ask yourself who's paying for it. Okay, what about goods on consignment? Goods on consignment. What are those sort of things? Well, let me give you an example. Let's say that you go to a Hallmark store and where they sell greeting cards and all that sort of stuff. And you can come off the PowerPoint if you want. And let's say that they have a little display. Let's say there's a little old lady that lives in the neighborhood that makes little bracelets or something. And she came to the Hallmark store and she said, I tell you what, will you sell these bracelets in your store? Just set them right here. And for every bracelet that you sell, I'll give you $2 or something like that. You see what I'm saying? Well, that is an example of a consignment situation. Now, the consignor would be the little old lady in that example. She's actually the owner of that inventory. Okay? And the consignee would be the little Hallmark store. Okay? So the old lady, the consignor, says, will you sell my goods in your store? Hallmark says, yes, we will. I think they get a little money for it. Hallmark is the consignee. The little old lady is the consignor. So going back to the PowerPoint, you can see that example. Another example that I have heard about is the shopping network. You ever watched Home Shopping Network?
I try not to.
I try not to as well, my friend. But like when they're selling, you know, whatever, necklaces or whatever, cookware or whatever, the items that they have, they're the consignee. They don't own those goods. Somebody is using the Home Shopping Network as a vehicle for selling their goods. Okay? Does that make sense? So the consignor is the one who owns the goods. Okay? Another situation. What about damaged or obsolete goods? What if you're doing an inventory count and you find some goods that have been damaged? Well, if they're completely trashed and they're just worthless, then you need to write down the books. They are not an asset. You have to decrease your merchandise inventory. Now, if they are maybe just scratched up or a little beat up, but they still have some value, you might not write them completely off your books, but you might just write them down to what we call the net realizable value. Okay, just decrease them a little bit if you still think you can sell them for something. Does that make sense? Has anybody here ever done an inventory count, by the way? Anybody ever participated? A lot of times they like to hire college kids to do inventory counts because you guys are, a lot of times they do them all night and you guys are used to pulling all-nighters. Okay? But you literally just go count things, don't you? What'd you count, Gil?
Just the suits and ties and dress shirts. And all that.
At where was it?
It was like a Men's Warehouse.
Men's Warehouse, okay. What'd you count?
My dad owns a fundraising company, and then like they have certain stuff in their warehouse, and you have to go count like how many frozen pizzas they have,
Okay.
how many chocolates they have.
Yeah. I've done a lot of inventory counts, and what I always say, I did one inventory count where I actually, for one of my clients, I counted whiskey barrels. Whiskey barrels. And I had another client, different client, where I counted Bibles. And I always thought that is the whole spectrum of things that you can count. Whiskey barrels to Bibles, right? So I've done a lot of inventory counts as well. But if you find some goods that are beat up, trashed, or whatever, then you have to adjust your inventory accordingly. Okay? All right, now what is important when we have inventory is that you have to include all expenditures necessary to bring an item to a sellable condition and location. So, if you do not just include the invoice cost, you include things like import duties, which are like a tax to get it into the country, storage, insurance, freight, all those sort of things. All those additional costs have to be included in the inventory cost. Okay? So, for example, if it costs me $600 to buy a piano, and I'm a piano retailer, if it costs me $600 to buy an electronic piano keyboard, and it costs me $50 to transport that, and another $30 to insure it while it's being transported, then the cost of that electronic keyboard is $680. You see what I'm saying? We wrap all those up into the cost of the inventory. Make sense? All right, and you can read about that in your book. Okay? And as we said, most companies take a physical count of their inventory. Most of the time, that's just once a year, because every now and then you have to make sure your books reflect reality. Okay? And we already talked about today, when the physical count does not match the inventory count, you have to make an adjustment to your books. Okay? All right, that is where we're going to end today. And what I want you to do for homework is, let me take a look here. Didn't know how much we'd get through today. Okay, what I want you to do for homework is the following. Hold on. Let's do these 3 quick studies. Okay? Let's do those 3 quick studies for homework. Okay? Now, the next few chapters, I want to make sure you have your handouts, okay? For you folks at home, make sure you have the inventory calculation handouts. SpongeBob Incorporated, I think, is the first one. Those will be in your blue book. We will use those a lot, and make sure the next class periods you have your calculators. Bring those for the next week or so, okay? Because we'll do some work in class. See you later.